What's going on, everybody? Welcome to today's Stock Market Brief Show. Let me tell you this week is going to get kind of crazy for the markets. We have earnings season heating up. We got major macro reports on the horizon. Presidential elections are looming in the background, and we have geopolitical tensions that are on the rise. So there's a lot to unpack. We'll dive into the current market conditions and how they could impact the trading days ahead. From commodities, crypto, volatility, you name it. You won't want to miss this episode, so grab your little hard kombucha and let's get into it. All right, ladies and gentlemen, welcome back to the show. We do have timestamps in the description below if you'd like to hop around. If you don't, then just buckle up. We're going to start off here with market performance. For the week, we take a look at the 11 sectors that make up the S&P 500. XLY led the way. Consumer discretionary, it's the things that people want. Tesla reported earnings, and the market absolutely loved what they saw. So this sector did finish positive in the green, barely. Now, towards the bottom of the list, we have materials, healthcare, industrial, financials, utilities, real estate. A lot of these took big hits on Friday's trading session. If we take a look over here at the market view, where we get those 11 sectors, plus some additional context, month to date, the 10-year yield is just on a rampant move. And then you see the dollar up there in the green, too. When you have these two leading the pack, it is common to see quite a bit of red on the screen. So you saw the dollar up on a week-to-date basis, the 10-year yield up on a week-to-date basis, and you're seeing a lot of red on the screen. Same thing goes here on the last trading day. You saw the 10-year yield up, you saw the dollar up, and you see a lot of red that happened to be on the screen. Now, these have made very big moves, and we've been talking about those, looking to potentially get digested in the near future, which could potentially help the market. So we got to keep a very close eye on that. Now, what is on deck? Well, we've mentioned big earnings are right around the corner. This week, it's going to be the largest earnings week where we're getting into the Mag 7 stocks, right? Google, Microsoft, Meta, Amazon, Apple. It's going to be a very, very critical week. These earnings are probably going to come out quite good, but what's going to matter the most is how they see the future. So look for guidance. Now, during this week ahead, I'll be giving expected moves for these products, so make sure you tune in or follow me on Twitter if you want to see them posted there, or in the Discord group, which it's through Patreon. So if you want to see that, there's a link in the description or the pinned comment. Okay, so these are going to be reporting amongst other big names, right? AMD is going to be a big one. I know a lot of people's eyes are on SoFi, Uber, all the good stuff over there to be watching, okay? As far as macro reports go, we have jobs data coming out. We have personal income, personal spending, GDP growth rate, non-farm payrolls, right? JOLTS. All this data is coming out next week. So not only do we have the biggest earnings week, not only do we have jobs reports, but the presidential election is nearing. And then Friday after the close, we noticed that geopolitical tensions definitely elevated with Israel's counterattack. There's the market conditions. Let's hop into this. Market conditions are incredibly important to be paying attention to, because as a trader or a swing trader, if you understand when market conditions change, it'll allow you to either put your foot on the gas and add more exposure into the markets, or to back off a little bit. So we're going to start off here looking at this trend changer, looking at various different ETFs such as the SPY, the Qs, IWM, semiconductors, XBI, and DIA. Originally saw Brian Shannon post this indicator, which it's just a color changing thing above or below the declining 5-day moving average. But I went ahead and made it for myself because I found it to be a great visual to share with everybody. Now, when we are red, it means we're below that declining 5-day moving average. When it's green, it's above a rising 5-day moving average. When it is yellow, it means that the 5-day moving is diverging from the current area of where price is. So, for example, if price is above the 5-day moving average, but yet it's trending down, it's going to be yellow. We don't have any of that on our screen right now. So as it stands in this moment, the market has to prove itself. The 5-day moving average is declining for the SPY, for the IWM as well, for the DIA, for the XBI, and not for the semiconductors and not for the Qs. However, they are rather flat overall. So it is good to see the Qs and the semiconductors still holding up. But what you'd prefer to see in these type of conditions is for the Qs to obviously hold and then come back up and maybe put in some higher lows for this 5-day moving average to start turning back up. And meanwhile, you'd want to see the same thing for the SPY to eventually start recouping that to head higher if you are bullish. These are the shorter time frames, right? Which we'll get into the other ones. Now that we know that the majority here is on a flat 5-day moving average, slightly up or mostly negative, doesn't mean that the market can't bounce from these levels. But the next element of this that we want to look at is gamma. And I'm pointing this out right here is because we're starting to kind of hit in and around this negative gamma territory. So when it's a bright green like this, we're in positive gamma. When it's a darker blue, it means we're in negative gamma. So 2 days ago, we're in negative gamma. And you can see that we're a very small area of positive gamma. And this means that we're very close to that gamma flip line. So the gamma flip line is roughly at 5,800. It's a little bit higher, but I'm just going to call it 5,800. And when we get below these gamma flip lines, this is where volatility can typically increase. Let me show you the times where we went into negative gamma. We went into negative gamma here, and then when we get out of the gray box is when we leave the negative gamma environment and we go to a positive gamma. So you can see here, when we go into negative gamma territory, there are pops in volatility, as you can see multiple times. And right now, volatility is rather elevated, so much so that if you look at VIX futures and you look at the active contract and even go out to December and January, we are in backwardation. So it is telling us that, hey, there is more action to be seen. The market's pricing in right now in the near future than it is out in December and in January, and they call this backwardation. So if you look at that, 19.9 is where VIX futures are here in November. December contract, you can see over here at 1903 and then 1917 out there in January. So things are elevated as far as whatever you want to call it, fear or just more implied move. The market is sensing more risk in the markets for the time ahead. If you look at volatility of volatility, the VVIX was up 6.97%, which is a pretty large move for volatility index. And I mean, if I'm just looking at this as a regular chart, which you're not typically supposed to do, but holy moly, this thing looks like it can fire off. Now, what can this be the result of? It could be the result of hedging activity. We saw volatility rise on Friday. We saw the market rise quite a bit on Friday until it reversed. So what was the case? What is going on here? And my guess was, as soon as the market closes, maybe the market was sniffing out the Israel Defense Force. They confirmed the start of an offensive operation against Iran. So this came out after the market closed, but it seemed as if volatility was kind of picking up on that. So that could be one of the narratives or reason why we saw some very interesting price action on Friday's close. Now, from what I understand, this is what came out, but then they've concluded their attack, I guess. We'd have to see if that's actually the case, but that is what I've heard as far as now. So we'll see how the market's going to respond to this and how various commodities and assets are going to respond to this. Typically, when you get these geopolitical tensions on the rise or attacks like this, assets like oil can see some massive volatility. Let's look at expected moves for the week. So what is the market as a whole coming together and expecting as far as risk ranges going in to the following week? And let me tell you, it's big, right? We're looking at $10.69 on the SPY. That's plus or minus. The last week was $7, a very small expected move. The week prior was 8, then 10.28, so it's a little bit higher than that. 9.81 and 7.70 the recent weeks. So this one coming into a very large expected move. So I'd be expecting us to tag one of these as the probability of hitting this for the last 2 years has been 75 to 80% of the time. So I'd be expecting this market to move the S&P 500, SPX move over 100 points, and then the SPY to move over $10 into this next week. If we take a look at the 15-minute time frame on the SPY, you can see we are below that declining 5-day moving average. We have the upper weekly expected move up here at 589.73. And over here, we have it at 568.35 to the low end. Going into Monday's trade, we have a daily implied move of 583.50. I'm rounding, and 570, I'm just going to round it to 574.50, right? Or 574.60, whatever you want to say. Okay. Right now, we are above the quarter-to-date anchored volume weighted average price, right? And also to look at the SPY from just a price action perspective, it is choppy. So right now, you just got to be a little bit more cautious. This type of volatile environments are good for day traders, but for swing traders in choppy environments, you can have a lot more fake outs, shakeouts, and so forth, and a lot of whipsaws take place, especially when you start to see us flip into negative gamma territory and below these declining 5-day moving average. So in my opinion right now, I would want to see the market prove itself, start breaking back out and moving forward ahead and remaining in positive gamma territory before I start really executing more capital. In the meantime, right? If the market wants to come down and I'm not pushing full throttle to the floor here, trying to add more exposure, buy the dip, and it keeps sinking, I just have my portfolio kind of flatline to maybe go down on some of my current positions, or maybe they go up because they perform well. Okay, I end up just managing what I have, and then when conditions change back for the better, I start putting more fuel into the fire, so to speak. Let's take a look at some of the indicators on various just different marketplaces here. This is the NASDAQ Composite Bullish Percent Index, and I shared this one a little bit ago, how when we have negative divergences here in the past, you can see that these negative divergences led to decent sell-offs and pullbacks in the market. So minus 13% on the last one, minus 20%. In my opinion, this doesn't mean it's going to be the same situation. However, it is worth noting that the market has been on a rampant rise. We just hit, in the NASDAQ Composite, a new high, right? It didn't close at a high, but we just hit a brand new all-time high with this negative divergence as well. So to see the market press up more, maybe potentially eventually resolve itself to the downside, I don't know how much, but then watch to see if a positive divergence eventually forms. Because once you're extended like this, you're going to eventually come back down into an oversold condition. And the last times that we've gotten bullish divergences in the RSI on the bullish percent index, that actually led to the market bottoms in both scenarios. NASDAQ Composite, as mentioned, so I can show you more specifically the chart. You can see that we didn't have a closing high, but we did hit to new all-time high territory, which is not necessarily a bearish thing. You look at the market, right? This broad market over here, all the averages are still moving up, the 20, the 50, the 200. So the overall larger trend is still very bullish, as we're seeing some of the smaller trends start to change to more bearish in the very short term. If we take a look at the bullish percent index for technology sector, this one is almost there to moving to oversold condition. And the market's holding up rather well. Now, I'm also pointing out the times that we've had bearish divergences here, and it's led to a sell-off into October of 2022. It sold off December into early 2023. Right over here was a longer one into July of 2023, and it led to the market decline there. Over here and going into going into 2024, it was a little bit of a pullback there. And then right over here too as well, it was a longer divergence that took to build out. But when the market started to realize this and start to move back into oversold conditions, we saw that July through August pullback. So right now we saw the bearish divergence, and what has price action done? It hasn't done anything. It's just gone sideways overall, and this is starting to resolve itself to the downside. So if this starts getting into an oversold condition, right, look for these positive divergences to form, or potentially just oversold conditions, and these might result in an area to start to find potential bounces in the technology sector. If you look at BPNY8, the NYSE bullish percent index, this was also a pretty big bearish divergence here, and that has resolved itself more towards the downside. So if we're going to have more downside, watch to see how it forms in an oversold condition. If we move on to the SPX bullish percent index, I posted this out on Twitter, and basically what I'm highlighting is when we get into this 75, above 70, 75, 80, or this area, and then we start turning back around down through 70, which right now it's not there. It's at 70.9%, which means that 70.9% of the stocks in the S&P 500 are on buy signals based off of point and figure charts. So when it crosses back down, I highlighted it each time in the last few years, 3 years, and you could see that the red lines are showing that actually the market sees weakness when you do cross down through that 70 from above it. However, there was an exception here in 2024, earlier 2024, where that was not the case. So what does this overall tell us? Well, it tells us that 10 out of the 11 times we saw sell-side activity take place. So does that guarantee that we're going to see sell-side take place if this crosses down? No, but if you look at probabilities, we have seen market weakness when that is the case. Now, coming into a week where we have all types of events, I think it's a time to just be a little bit cautious, because if the market likes what it sees, the market can press significantly higher, right? It goes kind of without saying there. The dollar has been on this rampant move, right? We saw some move to the downside on Thursday, Friday, right back up. And that pressure, when the dollar started turning back up, did put pressure on the S&P 500. So if the dollar wants to push higher here, perhaps that's going to continue to put pressure on the S&P 500. Overall, the S&P 500 has fared rather well since the dollar moved. In fact, since the dollar started moving to where it's now, the S&P 500 is still up from this point. But you can see that if you just look right to the left, we're not too far off of where we started the move with the dollar, meaning that this big move in the dollar kind of held the S&P 500 potentially back. And I say this because you can see that when the dollar has very strong moves, you can see the opposite happen. And then when the dollar started falling, you saw the opposite take place with the S&P 500. So one would think that if the market shakes out, but then all of a sudden the dollar comes back to the seasonality passes, the dollar takes a breather, is the market going to try to press and reach for that 6,000 level, which is incredibly important in terms of gamma, which we discussed that right over, where's the chart? Right over here. So you can see, 6,000 is all on the chart, but that's the call wall, meaning a big focus level for traders. Okay, let's go into some commodities now. Gold. This is intriguing to me because gold is at all-time highs, and this also has a negative correlation to the dollar, but the dollar's pressing higher and gold has not been affected. So what is the market basically saying here? Is the market saying that it sees something that there's no narrative to quite yet? Is there inflation going to come roaring back? I think this is all narratives that we're going to see play out in hindsight, but we need to be aware of what's taking place currently right now, and that is gold continuing to press to new highs, not being affected by a big move in the dollar, as well as a big move in yields. Another big one to pay attention to is silver. Silver had a massive breakout, and that move is being digested right now. If this consolidation takes place, and right now price action is getting rather tight, if it comes in, this could be a back test of a potential breakout, and don't rule it out for another rip in the price of silver. Now, in my opinion, if dollar is going to start coming down, and gold and silver have been doing good while it's been holding up, but typically there's a negative correlation, I think the next move in gold and silver can come from the back of a dollar basically coming off a little bit. So it's just in a situation or an area where the potential for a big move in some of these commodities can take place on the back of a dollar that falls. And it's going to be an interesting thing to watch when it plays out, because I tell you this, even the articles that are coming out, Market Watch and so forth, are saying that Wall Street is quite confused of the current conditions of today's market. Take a look at copper. Copper is getting very, very tight here too, as well as it's pulling back into its prior area of resistance. Resistance can become potential support. Now, copper is going to be a big one to watch. This is the one that has the copper is the PhD in economics, right? Dr. Copper. And the thought of copper rising could also basically tell us that, hey, we could be seeing a rise, obviously, inflation, or start to uptick again. And if copper starts breaking out to the upside, we've seen a very tight correlation that copper has to China because of how important that economic metal is to an economy the size of China's. And you can see that the positive correlation here from a 20-day period, it's almost a 1-for-1 over here, meaning that if copper is moving higher, China stocks could be potentially moving higher too. So my thought here is if we start to see copper uptick here and start to break out of this contraction pattern, it might be worth looking into some individual China equities, potentially China ETFs, and have some exposure for the possibility of a correlated play there. If we continue on and look at oil, not much to say here. I mean, it is just choppy and very volatile. There is the geopolitical tensions. We'll see if that is going to affect the price of oil. What I can tell you is this: if oil wants to start taking off, there's typically a high correlation to energy stocks. So if energy stocks start taking off too, what I have noticed and what I've shown in the past, I don't have the chart here, but if energy outperforms the S&P 500, that's typically not a good sign for the absolute performance of the S&P 500. So that'll be one to watch if energy wants to be the leader into the weeks ahead. Let's take a look at bonds and yields. 10-year yield, as we mentioned, has been on just a monster run-up. On the chart from the prior video, we highlighted that typically, actually, September to October, you get a rise in the 10-year yield. And obviously, conditions are different. We're in a raising rate environment over here, and now we're cutting rates. Well, whatever. I mean, we're cutting rates here, and it's doing the same thing that we're doing over here. So my thought is, if this is just a seasonal uptick, and it is going to start coming off, well, then that could be quite beneficial for various markets as well. So the 10-year yield, just obviously a very strong move. I'm watching the price momentum oscillator to see any signs of slowing down. We do have somewhat of a RSI that's in overbought conditions, perhaps a little divergence it's building, not as clear as day as the one over here with the price momentum oscillator that turned around. But you can see that if it does start slowing down in the near future, this will start turning around and potentially cross over in the weeks ahead. If we take a look at the 10-year, 2-year yield curve, this one is still in an uninverted state. So we've been inverted, we finally uninverted, but the ones that are still inverted is the 10-year 3-month, the 20-year 3-month, the 30-year 3-month. However, if you zoom right over here, that green line is the 20-year yield. The gray line is the 3-month, and you can see that there's only about a 4 basis point spread. So we're talking 0.4 basis points of inversion, and we've seen in the past when the 3-month inverts the 10-year, 20-year, 30-year, it's only been a few times in the last 25, 30 years that's been the case. But there's typically quite a bit of volatility that has hit the markets when this thing really does come off and they begin to all uninvert, which it's just not there yet, but it's not far off. If we take a look at what the Fed is doing as far as probabilities of a rate cut, this is a huge market. It's one that could be traded. We're looking at the Fed Watch tool. But looking into November 7th meeting, you can see that the probabilities of no rate cut are kind of declining, and a 25 basis point cut is basically being locked in at almost a 100% probability that we'll be seeing a 25 basis point cut. If you go to the end of the year, so into December, you can see here that it's pricing in about another 25 basis point cut as it stands right now. So the market is saying we want the Fed, or ideally the probability of what the Fed is going to be doing is going to be cutting another 50 basis points from where we currently stand, which is interesting when we're seeing things like the 10-year yield rise, copper potentially on the move, right? Oil's rather choppy. Gold has been on a huge move. The point of the Fed's monetary policy here is to make sure that inflation, it reduces back to their target of 2%, and that obviously we see the economy doing fine too as well through various measures such as jobs, which we're going to be getting, and that's could very well potentially change the outlook of the Fed Watch tool. But if inflation turns back around and starts to rise, what would be the reasoning for the Fed to continue to cut rates? Perhaps we'll find out November 7th when we hear from the press conference. Let's take a look at some crypto now. Now, there's a lot of different crypto equities. They took a hit on Friday, so here's a big list of them that I kind of put together from Mara, Riot, CLS, BitX, which is a leverage fund, Hive, ETH, well, you name it. There's a lot of them on here. A lot of them took hits on Friday. The Sailor to Shift tool actually flipped down to a sell signal. There's been no official trigger here, and I don't know if it's going to close down here come Sunday or when we get the new weekly candle, but it is, at the moment, signaling a sell signal. Now, we did see the market come off a little bit. Now, from an absolute perspective, looking at just price action, doesn't look bad at all. It looks pretty good. So what would be the official trigger? Well, next week, we'd have to cross below, if we get a sell signal, we'd have to cross below about 65,000 to consider it a trigger. And then I'd have to wait to see if this turns back up. Now, if I zoom in, I can show you it a little bit more clear, see how we cross underneath the zero line, which is the rate of change between Bitcoin and gold. And really, it's just an inside trading week. So, and it's a potential on the move of a breakout. So it doesn't look horrible. It looks pretty good in my opinion. So can it be a potential whipsaw? It could very well be. I don't know. But we'll see what it looks like if we actually get the sell trigger and kind of revisit that. If we go over to Bitcoin on the daily chart, you are seeing a series of higher lows. You are seeing a series of higher highs. So now what you want to see is obviously price action to break over here, which would be roughly at about the 70,000. And if that happens, I think we can see a quick shot up $2,000 to $4,000 higher to retest these prior highs. Ethereum has been one that has just not had the same amount of love. And you can see that we're just kind of flailing around here, potentially still building out an inverse head and shoulders or a potential base in something like ETH. But we need to see some strength come in, another higher low, potentially get tighter right at around 2,700, potentially fire off to and around 2,900 to 3,100, 3,200. That's all I got for you on today's episode, everybody. We discussed quite a bit. Just be careful, be safe out there. There's a lot of things that are confusing a lot of traders and a lot of investors. So I always like to bring it back to the conditions of the market to determine whether or not I can be pushing my foot down on the throttle or taking it off. And right now it's saying we're a little confused. We're right near the flip line. Volatility has been upticking. The volatility of volatility has been upticking. Be careful out there. That's all we got on today's episode. Hope it helps out. See you later.